We look at trade for the week ahead. We want to remind investors and traders that we are off on Monday as the markets will be closed in observance of Memorial Day. We want to thank all of our servicemen and women for their service. Let's look at economic data that we have on top, because even though there's only 4 days of trade, Mike, there is a lot that we have to look for, particularly manufacturing, housing, and consumer confidence numbers, GDP on Friday. And I think between GDP and manufacturing, interest rates are really going to be the theme next week.
Well, I think interest rates do remain the theme, and actually I think the home data is one of the things that, and durable goods, have particular interest to me. If we think about what rates are supposed to do, they're supposed to support those two sectors specifically. We're trying to reinvigorate the housing market, and of course low rates encourage consumers to buy all kinds of durable goods, especially things like cars. So I think that's going to be really quite critical. The other thing I would really point out is we're about to move to a really interesting time in the market. The period between Memorial Day and Labor Day is sometimes very quiet. You know, people think, oh, you sell in May and go away. In fact, the truth is you probably shouldn't do that. We've taken a look at some of the historical data, and in fact, you should probably remain invested. The one thing I would point out is that this is a great time, number one, to think about selling premium. Do not sell premium, though, beyond Labor Day. Don't look to sell September options. And the reason is everybody thinks of October as being like the worst month, but in fact September has historically been a very volatile one. So we are moving into a period where it's going to be a great time to basically see the market probably remain fairly stable. But I would watch out. Just keep your eye open. Don't get too complacent while you're sitting at the beach.
Well, you know what? Let this month be a lesson to you. Sell in May. It certainly did not make sense to sell in May. I mean, what are we up? Over 6 points on the S&P just in the first half of the session. Looking towards volatility events for next week. While we don't have any earnings, any companies reporting earnings in the Action Alerts Plus portfolio, what we like to look for in addition to earnings are volatility events such as FDA approvals that are on tap, companies presenting at sell-side broker conferences. And I actually like this much better than earnings. You know it's going to come out pre or post-market, but the intraday tidbits that you get at the conferences, that's where you get some great intraday action. So we have 5 stocks on tap: Honeywell, EOG Resources, StarBucks, MasterCard, and M. So we could look for some trading there. Whether or not we make adjustments in the positions, we want to have that on our radar in case we do see some of those moves.
I think that's a really important point that a lot of people miss, is that they only think about the big economic data points, or they look at corporate earnings and think that those are the only things you really need to concern yourselves with. Actually, there's some real opportunity, again, for selling premium when you have these types of events. Apple has the Worldwide Developer Conference that's going to be coming up in early June. But what you often see in situations like this is right after earnings, you think options premiums are going to collapse. They don't, and that actually provides an additional selling opportunity. So we're probably going to be looking to do that in some of these names that we're talking about. And I think that's an important thing for people to just remember in general. Pay attention to those calendars, folks.
Right.
Those types of the institutional players, this is what they focus on, and you can really see it, because when they do this, you'll see a stock move a couple of points and you don't know what it is. They might be making a presentation. Institutional investors are there. They're paying close attention, and they know how to digest that information, and you can too.
Well, there are a couple of other names in the retail space that are reporting next week in terms of earnings, and it's been a very interesting 2 weeks in the consumer space because the data has not really been as strong as analysts had expected. The weaker gasoline prices really hasn't been contributing more to consumers' discretionary spending. Costco, I'm going to be really interested to watch that one. Walmart and Target. Walmart didn't do that well. Target outperformed exceptionally well. So I want to see where Costco falls in between their Michael Kors. Coach did not do well. I want to see how well they do. You have Tiffany, Ulta, Gamestop is another one. I can't really wrap my head around Gamestop. You would think, as much as that stock has flown with all the online gaming, the physical location in buying games, I just can't wrap my head around it.
There's 2 quick points I would make about the expectations some people had for consumer spending as it relates to gasoline prices. The first thing is, it has obviously put a lot more money into consumers' pockets. We're talking about hundreds of billions of dollars in total. But I think there's evidence when we take a look at car sales that a lot of consumers are not convinced that low gasoline prices are going to last forever. And they're not going out and always going up and buying the most expensive and gas-guzzling SUV. That suggests that they're not going to go out and spend that newfound money because they don't think it's going to last that long. The other thing is, we had tax season in April, and actually, because there was some wage growth, there was actually more payments made for taxes this year than there had been historically. The refunds are scheduled to be about the same amount, but the amounts that were actually submitted with tax returns this year was higher by about $40 billion. So that eats up a little portion of it as well. I think those 2 things had people probably getting a little too bulled up on the consumer names, thinking that they were going to go out and start spending really aggressively, and they didn't do it, and I think those are 2 of the reasons why.
Well, I just think consumers are really shell-shocked from the financial crisis, and savings rates could have possibly gone up because of that. And if you're going to be saving and not using consumer discretionary spending money, it kind of makes sense that the retailers are not going to perform as well.
Yeah, the other thing is that when equity prices continue to rise or housing prices continue to rise, it also encourages people to save, because they're going to sit there and say, well, actually, I'm not going to go out and take this short-term newfound money when I could in fact be investing it. I think if you start to see the markets actually stabilize, this might seem counterintuitive, there won't be as much enthusiasm for putting money to work in the markets, and people might put it to work at places like Macy's instead. So those are two things. I haven't really heard anybody discuss it, but I think that investor psychology might also be playing into how much we're seeing people spend in retail.
All right, thanks very much, Mike.
Sure.
For The Street in New York, I'm Jill Malandrino.